Are you interested in passively investing in real estate but aren't sure if you should invest in a syndication or a fund? In this video, I'm going to walk you through how syndications and funds are structured and the key differences between them. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book Sell For More. So let's get right into it and talk about syndications and funds and the key differences between them. So I'm going to do some arts and crafts right now. Bear with me. I'm going to attempt to draw two circles. And actually, these aren't too bad. With syndications and funds, the structure is very similar, but like I alluded to, there are key differences. So we have two parts to a syndication and a fund. We have the GP and the LP. LP stands for limited partners. These are the passive investors, and GP are the general partners or the active parties in that syndication or the fund. So a limited partner, these are your capital investors. They have the money that they want to invest in real estate, whether it's a property, so through a syndication, or a fund. So these are all the different investors, and typically these are accredited investors. So they're doctors, lawyers, accountants, business owners, programmers, people who meet the accredited investor criteria. So they make $200,000 a year or more, or $300,000 as a couple, or they have $1 million of assets, not including their principal residence. So these people have their capital, but they don't have the real estate experience. They're just doing what they do best in their day-to-day career, whether it's saving lives or giving expert legal advice or running their business empire. They don't have time, they don't have the energy, they don't have the resources necessary to start from the bottom again and learn the real estate business. So they invest their capital with the general partners. These are the active parties. They have the real estate experience, they have the network, they have the relationships with brokers. Brokers will actually answer their phone calls because they have the track record, and brokers and sellers know that these guys will close on a transaction. For myself, I've been in the real estate business now for 12 years, and you build your reputation, and you have to treat that very, very carefully. So the GPs are the active parties right here, and the LPs, they're the passive investors. Now, LPs are afforded protections under the law. So let's say a deal blows up or the fund blows up. Well, the GPs are on the hook for everything. All the lenders, everybody else is going to come after the GPs. The LPs are risking their capital, but they're not on the hook for everything else. So they, like I said, they are afforded protections under the law. So again, with any investment, whether it's stocks, bonds, even real estate, investing in businesses, whenever you invest your capital, you are putting that at risk. But this type of structure really affords a lot of protections to those passive investors. So now let's get into the differences. Now that we know how these are structured, the differences between a syndication and a fund. So with the syndication, it's on a property by property basis, a case by case basis. So what happens is, let's say me as a syndicator, I have this property right here. We can say it's a 200-unit apartment building. I have this under contract. It's a good deal. It's going to meet the return requirements that I have for my investors. I start raising the capital from my database of investors, and the investor, when I approach them with the deal, they can say, I like this deal, I would love to invest, or this isn't right for me, or I have my money tied up somewhere else right now, I'll just wait until the next deal. The investor can decide whether or not they want to invest in that specific property. It's on a case-by-case basis because the syndication is one property only. Now with the fund, this switches up a little bit. So let's say this is my fund right here. The fund itself can have multiple properties. It can have 5 properties, it can have 30, it can have 100 properties. And over the lifetime of the fund will buy and sell properties, and it really have a life of its own. A typical syndication, you can be involved in the syndication for 5 to 10 years, let's say on average. With a fund can have a lifespan of 30 years or plus. So it's really important when you're looking at a fund, you really have to understand the fund criteria. Because like I said, with the syndication, the investor can look at that specific property that they will be investing in and decide whether or not they want to invest. With a fund, you don't necessarily invest in a specific property, you are investing in the fund criteria. So I'll just make up a fund criteria right now. It would be properties in the southeast states or provinces, wherever you live, looking at B- to A- properties, 200 units and plus with multifamily, with a return of, property by property of, let's say, 12 to 17%. That could be typical fund criteria. The investors, the LPs with their capital, they're investing based on that criteria, so they have to really trust that the GPs running the fund have the experience, they know what they're doing, so they can put their money at work because they're not investing on a case-by-case basis. So if you're an investor who wants more control over where their money goes, doing a syndication gives you a lot of control because you can say yay or nay based on that specific property. But if you're an investor who wants to invest in a fund and have that money spread out over numerous properties and not have to go through 20 different syndications to get that spread, a fund could be a great opportunity for you. And a fund also has some advantages because they have their money, their war chest, sitting there right off the bat. So if they do come across the distressed seller, that fund can jump on that opportunity and often get better price and terms because they have that money ready to go, whereas the syndicator has to go out and raise that capital before they can close on the deal. So hopefully this really explained and gave you a good idea of the difference between a fund and a syndication. Very similar structure, but there are key important differences between them. So if you want to learn about the deals that I'm currently investing in and what I'm working on, head over to callseth.com and we can set up a quick 20-minute phone call. And if you like this video, if you found this helpful, hit the like button, leave a comment, let me know what you think. And until next time, happy investing.